Everybody wants to build the next Amazon. But what if chasing Amazon's playbook is exactly what's going to destroy your business? This isn't just a startup debate. It's a trillion-dollar question that has quietly bankrupted thousands of companies while making a handful of founders obscenely rich. Let's back up and understand what we're actually arguing about. Because scale fast and grow profitably aren't just strategies, they're entire belief systems. One says, burn cash now, dominate later. The other says, earn your way forward, brick by brick, dollar by dollar. Think of it like two restaurants opening on the same block. One maxes out every credit card to open 10 locations in year one, and the other perfects one location until the waitlist wraps around the building. Both owners are convinced they're the genius, and statistically, one of them is catastrophically wrong. The scale or die religion really took hold somewhere around 2008 to 2012, when venture capital started acting less like investing and more like a land grab in a gold rush. Sequoia, Andreessen, Tiger Global, these firms were handing out checks like Halloween candy, betting that whoever captured the most users fastest would eventually figure out the profits part. And look, for a hot minute, it worked. Uber, WeWork, DoorDash all looked like unstoppable rockets until the interest rates changed and suddenly everyone remembered that a business is supposed to, make money. WeWork went from a $97 billion valuation to nearly zero faster than you can say, we are a tech company, we promise. Here's the macroeconomic truth nobody puts on a pitch deck. Cheap money makes blitzscaling look like genius, and expensive money makes it look like fraud. When the Federal Reserve kept rates near zero for over a decade, burning investor cash to buy market share was essentially free. But the moment rates climbed past 5%, the whole model collapsed like a wet cardboard box. Now, contrast that with companies like Patagonia, Basecamp, or MailChimp, slow, profitable, almost boring by Silicon Valley standards. And you'll notice something wild. They're still here, still growing, and their founders actually own their companies. MailChimp sold for $12 billion in 2021 without ever taking a single dollar of venture capital. History keeps rhyming on this, and it's almost embarrassing how predictable the cycle is. Cheap capital era spawns a generation of growth at all costs darlings, valuations detached from reality. Rates rise, the music stops, and suddenly profitability is the new black. We saw it in the dot-com bust of 2000, the post-GFC hangover, and again in 2022 when high-growth tech stocks got cut in half or worse. The real psychological trap here is that scaling fast feels like winning, even when you're losing. You've got press coverage, you've got users, you've got a gorgeous office with a cold brew on tap, but if your unit economics are broken, you're just a very stylish bonfire of other people's money. Here's the misconception worth killing right now. Slow, profitable growth is not the same as playing it safe or lacking ambition. Berkshire Hathaway compounded at roughly 19 to 20% annually for 6 decades. Not by moonshots, but by disciplined, boring, repeatable acquisition of cash-generating businesses. Warren Buffett is not exactly known for his boldness in vibes. The practical lesson hiding in all of this is embarrassingly simple. Know your unit economics before you pour gasoline on the fire. If it costs you $120 to acquire a customer who only spends $80 with you, scaling faster doesn't fix the problem. It just digs the hole deeper, faster, with more witnesses. What actually creates long-term value is sustainable competitive advantage built on real margins, real retention, and a business model that doesn't require a zero interest rate environment to survive. Grow at the speed your customers and cash flow confirm, not the speed your ego or your investors demand. The discipline here is unglamorous but unavoidable. Size your bets relative to conviction, stay solvent long enough to be right, and resist the cultural pressure to confuse activity with progress. A smaller, profitable company that you own is worth infinitely more than a large, unprofitable company that owns you. At the end of the day, the best businesses aren't the ones that scaled the fastest or the slowest. They're the ones that knew which mode fit their moment and had the discipline to execute without losing the plot. You can be bold and patient at the same time. In fact, the most dangerous competitors in any market usually are. And whatever path you choose, aggressive or measured, the math always wins eventually. So build something the math loves. If you're ready to put these principles to work in the real world through real estate investing, home contracting projects, or connecting with the right lenders, check out our links in the description below.